Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist, taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
Hi, everyone. Welcome to episode 72 of Carson's Facts versus Feelings with Ryan and Sonu. Sonu, we're going to go about 20, 25 minutes. And then, I think the meat of this discussion we've pre-recorded already with Matt Hougan. We're going to talk about the Bitcoin ETFs. He's the CEO over at Bitwise. That was a fun discussion, wasn't it?
Oh, yeah. No, I think I learned a lot. And
yeah.
Mostly as to, obviously we allocate portfolios and we allocate to different asset classes. And one thing he mentioned was thinking about Bitcoin as an asset class. I know a lot of times it's talked about as a currency, but I think set that aside, there's several reasons why you don't want to go buy Starbucks with Bitcoin, right? Yeah. It's an asset class. And then when you think about, okay, it's an asset class, I include it in my portfolios, how should I think about it? In terms of risk and future returns, right? So I think Matt gave some awesome perspective for all of that.
Absolutely. I mean, we're trying to do all we can to help the industry and help our Carson partners. And, hey, the Bitcoin ETFs are out there, so we wanted to have one of the very best in the industry to discuss it with, and obviously Matt is there. So Sonu, you and I are going to go 20 minutes. We're going to talk a little bit about CPI, which just came out, a little bit about markets, February, some seasonality stuff after the huge run we've had, and then what we're going to finish it with. Oh, the consumer. The consumer is not as tapped out as so many people keep saying. So before I go there, I guess the numbers are in. 123 million people watched the Super Bowl, the most anyone's ever, a group of people have watched anything since we landed on the moon, apparently. Didn't know that one.
Is that true?
Hey, I saw it on the internet. It's got to be true. I saw it on the internet. But a lot of people watched. I know you did learn the Niners in the NFC, and you learned Kansas City's in the AFC.
Don't quiz me.
We're not. We'll bring that up in about 11 months. Don't worry. We'll see if you still remember. Are you going to miss hearing about Taylor Swift every Sunday, or are you excited to move on?
I'm kind of excited to move on. But that's just me. No offense to anybody who's a fan. But
well, I tend to agree. But congrats to the Chiefs. Niners didn't do themselves any favors. But hey, that's football. That's sports. That's life. You got to make the small plays, or they lead up to something bigger, and it is what it is. So, all right. So now let's get into it. So again, this morning is what is today's date? So the 13th.
Tuesday, the 13th.
It's the day before Valentine's Day, everybody. So hopefully by the time you hear this, it'll be Valentine's Day, and I'm going to take my wife to lunch.
I need to get flowers.
Yeah, I was going to do that today. I was going to take my wife to lunch tomorrow. And then we're actually going to go to my son, Gus. He's our youngest son. We're going to go to his Valentine's Day party and be chaperones, which is something that I don't know. Nice. I just kind of stand off in the corner and watch it all, but my wife takes charge. But I just like to go do that when I can. I'm in town, so I might as well do it. All right, so again, what the big, I'm sure at the time people listen to this too, it'll still be a big deal. CPI came in, quote unquote, hotter than expected. That's Consumer Price Index, a price of goods and services that people pay for. Hotter than expected. And the market is selling off pretty hard. Now, let's be clear. We're going to talk about the market next. We've had a heck of a run. So I think we're just due for an excuse to sell off. Is this the excuse we were looking for, Sonu?
I think so. And today's CPI data, today is in February 13th, this CPI data for January, is a good reminder that narrative is important. I think that's what it comes down to. There's the data, and I'll talk about the data and what's under the hood. I think that's important. Yeah. But narrative is important. And what's the narrative? The narrative coming in for the last month, through the end of last year, the narrative, the Fed's going to cut. Maybe they'll cut as early as March. And we've slowly been shifting away from that narrative. And today's CPI data puts a sort of, there is a nail in the coffin to that narrative in a way, that rate cuts are coming sooner rather than later. And we're going to get a lot of that. No. Right? March is, we're not going to talk about March rate cuts anymore. May is also a low probability event, at least the way markets are pricing it in terms of the Fed cutting interest rates, the first cut, right? So, I still think May is a possibility given, we have 3 months of data. So a lot will happen. I'm not saying a lot can happen. I'm pretty sure a lot will happen. And so I would say the odds of a May rate cut, I would still put it at maybe 60, 65%. I think the market's taking that as maybe 30, 40%. But I think that's immediate reaction, right? But narrative is important. A lot of what you talk about is around that narrative too. We can talk about details later.
Yeah, let me jump in there. I mean, so again, it's as simple as, listen, yes, the numbers were a little hot, right? A little higher than expected, I guess. But, you look historically, January is a more volatile month when it comes to economic data. And you tend to get more revisions in the month of January. So we're not minimizing it, right? It's just one data point. One data point does not make a trend, said Master Yoda. So we have to remember that if we see more data points that confirm higher inflation. But Sonu, you and I are sharing some notes. I did a Yahoo hit just a little bit ago. And you were like, it's all shelter. there's the bullet point, right? It's all, and I mean, and we keep, it feels like we keep saying this because shelter is a huge part of inflation, yet the private data keeps saying it should come back. All these economists saying it should come back. Everybody keeps saying rent prices should come back. We are seeing it some places, yet the government's data just isn't showing it. I mean, I don't know. It's confusing a lot of us. Well, what's going on there?
So headline inflation came up at 0.3%, month over month. It takes over the last year, it's 3.1%. But really, we've talked about this. The 12-month pace takes into account what happened last year, right?
Sure.
I mean, it's not a bad thing to look at. Look at the 3-month pace, 2.8%. And he's like, oh, wait, that's hot, right? But then shelter comes in. Shelter, and this is headline inflation. Shelter makes up about a third of the CPI. Overall basket makes up about more than 40% once you strip out energy and food. So shelter, all this to say, is a big piece of official CPI data, not PCE. We'll talk about PCE separately, which is what the Fed focuses on and I'll get to the reasons for that, right? But CPI, a third of the index, right? So you take shelter out, right? And I think there's a very good reason, literally, because of like what you said, right? Every private market data, even anecdotal data. I was looking at an article, I think in the Wall Street Journal or Bloomberg, about like there's a huge rental market supply in Austin, Texas. So rents are going down. That's what you get. More supply, rent prices go down. You're seeing that in private data. Apartment List has an index which you and I follow. I know I'm looking at my data right now. 8 consecutive months, rents have been down year over year. And then today, CPI data comes out. What happens, right? So there are two pieces to rents over here. One is actually actual rents, what people pay for, like out of 33% in the basket, about 10, 12% is, people renting their homes, apartments, whatever it is. That's what it measures. But 20%, a big chunk of it, so a fifth of the basket, a little bit more than that, is homeowners rent, right? Now, that sounds kind of crazy. It's not actually home prices. Home prices, just to be clear, are not in CPI, right? We just assume you're a homeowner, I'm a homeowner as well. It assumes I'm renting to myself. That's a service. Now, what's the prevailing price of that at which I rent to myself? That's based on market rents. So it's all based on rents. So which is why when we talk about shelter, all we talk about is rents, right? And the official shelter inflation data, for multiple reasons, you've written about it, I've written about it, it lags by about a good 8 to 12 months.
Yep.
And we've been expecting it to fall. And the good news is, look, there is a downtrend. But this month, that second piece of it, the larger piece, owner's equivalent rent, it jumped to 0.6%. What does that mean? It went at an annualized pace, right? If you annualize that month over month increase in January, it's almost 7%, Ryan. And that's the largest increase we've seen in owner's equivalent rent since April of last year. So that just completely threw everything off. Yes, and to your point, that's a very important one. January is a messy month for economic data. You get seasonal adjustments, revisions, all sorts of things. But this one is really about shelter. Strip shelter out. Last 3 months, headline inflation is running at 1.1%. Last 6 months, if you strip shelter out, headline inflation is running at 2.1%. I think that's the big picture. We still have low inflation. It's CPI for, can I say, artificial reasons, is being elevated because the official data are lagging.
Yeah, well,
I'll just put it at that.
Artificial intelligence is a key word. So for those Google searches, maybe we should put the word artificial in the title and people will actually look at it. Nonetheless, so that's a good discussion. I don't think we need to spend too much more time there. Again, PPI is coming out. We've got more inflation data coming. I mean, this was mildly concerning, but again, more shocking and surprising, I guess, how the government keeps seeing higher shelter prices. We've talked a lot about that. So we're going to go another 10 minutes or so approximately, but let's talk Super Bowl one more time. Commercials commercials. I
All right.
personally like Creed. We literally titled this podcast, and a lot of you reached out, by the way, that you agreed. You like that? Take Me Higher. I like the Creed commercial with Captain Picard, and he throws a little cartoon guy, and I know he was dressed as a superhero, whoever it was. I don't follow superheroes. I'm going to call him Captain Picard, but Creed playing Can You Take Me Higher, little guy going and smashing into the wall. I thought that was pretty darn funny. I also like the Reese Peanut Butter Cup one because I love Reese Peanut Butter Cups also.
Oh, yeah.
They mentioned how they're going to change the recipe, and everyone just starts destroying the house and yelling and screaming. Then they go, well, actually, we're not going to change that. This is just extra, and then everyone calms down. And I thought those two were funny, but I know the one you liked, and I can't disagree. Which ones did you like there from the commercials?
I like, speaking of Reese's, my wife's from Ohio too, so I think maybe it's an Ohio Buckeye chocolate and peanut butter thing. She loves Reese's too.
Yeah.
So, I mean, I'm not saying I don't like. I like it, and I like dark chocolate a little bit more. But I like that BMW commercial a little bit with Christopher Walken making fun of himself. That was fun, I thought. And I think I've always looked like, what are the commercials you really remember from previous Super Bowls? Usually it's the car companies, which is interesting. I remember there was a Clint Eastwood one with Chrysler a few years back, and then this time I thought the Dunkin' one was funny. I mean, I do like Dunkin' Donuts more than Starbucks. I think I was telling you. So that was funny. I mean, it had celebrities. What more do you want?
No, those are good. I mean, overall, halftime, mixed reviews. I wouldn't so into halftime this year, but nonetheless, my wife loved it, so I get it. It's mixed reviews. But with that, this is episode 72 of Carson's Facts versus Feelings, right, with Ryan and Sonu, talking about the Bitcoin ETFs with Matt Hougan, and this is sponsored by Y Charts. I don't think I said it at the beginning, so we might owe Y Charts another one. But sorry, this one is sponsored by our friends over at Y Charts there. And again, you can help us out. Let me just read this word for it here. Help us out by telling us how we're doing. Leave a review, leave the thumb button, or use the thumb buttons, and subscribe if you want to hear the latest. And also, Facts versus Feelings, versus is VS, Facts versus Feelings at carsongroup.com is our email. You can shoot us an email, and we'd love to hear how we're doing and what you want us to talk about. All right, Sonu, so we've got a little bit of time here. Let's talk about the stock market.
Banana peel month. Maybe the CPI data is the banana here, huh? Or the banana peel.
I mean, it's fascinating, because I've talked a little bit about this before, a little bit as in like every week, how well seasonality's played out. And if that were to continue, you'd have to say, the second half of February into later March, historically, is not all that great in a couple of scenarios. Specifically, if it's the fourth year of a new president, this is kind of that banana peel time. When you're up 20% the previous year, February tends to be weak. February of an election year tends to be weak. February in general tends to be a little weak as well. At our Carson cycle composite, I've shared this on X before, but looks at various years, 8 or 9 different years, kind of smush them all together. And that cycle composite peaks around now, bottoms. Now, believe me, we're not saying there's going to be some major market calamity. I'm just saying S&P is up 14 out of 15 weeks and gained more than 20% over those 15 weeks, Sonu. In the history of the S&P 500, that has never happened. Yes, we've had 20% gains in 15 weeks. Yes, we've been up 14 out of 15, most recently 1972. But to be up 14 out of 15 and up 20% those 15 weeks has never happened. Listen, that kind of says, maybe we could have a little well-deserved break. We've been bullish. We've been overweight equities. It's been a nice run. But we're also aware that maybe there could be a little pullback. One final comment, Sonu, then I'll pull you in. Let me make sure I find it here. Yeah, when you're up 20% over a 15-week period, like we just were, higher a year later, 86% of the time, pretty sure it's 14 out of 16 times, up 12.5% on average, median of 13. So it's after a huge surge in 15 weeks, you tend to be stronger than average a year later. That's still why we remain overweight equities. We still are optimistic later in an election years when you tend to get more strength. I think that might play out again here. So just some things to think about right here and now when we finally see, I'm looking to my left. That's where I look. There's a color on the screen. I don't even know I think it's red. I don't even if you're shocked when you look at your TV and you see some red, just remember we haven't had any of that in a long time, and it's kind of normal. All right, Sonu, what do you want to add to anything I just pointed out there before we talk about the consumer?
Now, you mentioned like 14 out of 15 weeks, the market's been up. I mean, summarizing basically what we said, it's very unlikely 4 weeks from now we'd be looking at 17 out of 18 weeks.
True.
Right.
That'll be a
or 18 out
wild.
of 19.
That'll be a wild St. Patrick's Day if so. Yeah.
So momentum is good, but at some point, like, things can't keep going up, right? And I think that should be well understood by anyone. And like you put it out there in some of your pieces, and I know our boss Bert White says this, like, volatility is the toll you pay to invest. There cannot be no volatility. I mean, there will be volatility. Expect a pullback. It could even be a correction. Who knows, right? But that's just par for the course.
Well, exactly. And then one more little interesting factoid. This went nuts on Twitter. People liked it, so I'll share it here. When you have a 5%, when you're up, so how do I want to put this? When you're up year to date 5% at some point during February, like we were this year. So we're going to call that a good start to the year, right? We'll call that a good start. Found 28 times that's happened. This year's at 28 times. The next 10 months, so we'll call it almost the rest of the year, has been higher 25 times, up 13.3% versus an average final 10 months of 8.1. The full year been higher 26 out of 28 times. Full year up 21.3% on average versus your average year, which gains about 9.3%. So listen, great start. Probably still bullish. The strength we've seen in the last 15 weeks, probably bigger picture, structurally bullish. Just be aware that it's not going to be a straight line, and maybe we could have a little break. All right, so that's a good session there. I mean, we want to make sure we kind of keep this tight so people can listen to the awesome discussion with Matt Hougan over at Bitwise. Final thing, I keep hearing how the consumer is just strapped 1.13 trillion in credit card debt, foreclosures, bankruptcies. We're seeing all these scary things, delinquencies. We're hearing it all. You looked, and I always forget exactly what it's called, so tell me exactly what that report's called. From the Fed, I think it's the Fed who comes up with that report, right?
Yeah. It's a New York Fed.
New York. Oh, that's right. The New York Fed. Yeah, I like the New York Fed. They're good. Yeah, the New York Fed. What is that report called? How often does it come out? And what did you find when you dug into those numbers on the consumer?
Yeah, it's a New York Fed's household credit and debt report. It looks at credit decomposition, right? Like by age and things like that. But mainly, what is household debt, right? Household debt, it increased in the fourth quarter from the third quarter. It increased by from 17.3 trillion to 17.5 trillion. And you look at that, oh my God, that's such a big number. Yeah. But look, I was talking about composition. Most of that is mortgage debt, right? So mortgage debt, it makes up about 12 to 12.5 million once you include like home equity loans, things like that. Auto loans make up, a smaller portion of that. And credit card debt, auto loans is, last month, it's about 1.6 trillion. I'm looking at data. Credit card debt about 1.13. Yeah, literally what you said, right? And so credit card debt gets a lot of attention. I don't think it's a bad thing because, in the financial advisory industry, you don't want people to take on a lot of credit card debt and pay, interest rates up to your eyeballs, 25, 30% on this thing, right? So in some sense, I get why there's a lot of focus on it. But from a macro perspective, look, credit card debt went up, but you have to take the full picture into mind. Like, how is overall debt growing, right? Actually, debt growth year over year is actually slowing. In 2023, it was up 3.6%. In 2022, it was up 8.5%, mostly because of inflation. But in 2019, it was up 4.4%. So last year, debt growth in debt, was smaller than we saw before the pandemic, right? And here's a big picture. Overall debt grew just under 1 trillion in 2023, including credit cards, but disposable income rose 1.3 trillion. That's very rare for overall. And this, when I mean disposable income, it's disposable income across everyone in the economy. Just like when we talk about debt, it's debt across everyone in the economy, households, right? And it's rare to see disposable income grow faster than debt because remember, income is important with respect to debt because that's what you use to service the debt. I mean, nobody's paying off all the debt immediately. I'm not paying off my mortgage debt like with all the income, with my salary in 1 year or 1 month. No, it doesn't work that way. But I'm using it to service the debt. But the fact that overall incomes grew more than the rate at which debt grew, that's amazing. And it tells you that households delevered, right? And that's your dry powder for the economy.
Yeah, it's a great point because I didn't think of this, but like my daughter just turned 16, Susanna, and we got her a car. right? And that car wasn't necessarily cheap because used cars are expensive, as we've talked about before. And I was thinking, yeah, that's more debt. And we're not paying that off right away. Yeah, it's a little more expensive than some of our other cars because rates are higher. But nonetheless, that means, quote unquote, we have more debt than we did 6 months ago or a year ago because it's added this third car on there. But I'm like, believe me, it cost me an extra $500 a month. I'm not minimizing the extra $500 a month that her car cost me. Yeah. But I will say this: I get to sleep in every morning now. I used to take her to school. I don't have to go pick her up at 9:30. So some friends have told me I mentioned this last week, I think, but my insurance went from $2,100 to $4,500. Okay, so that's a lot, and I'm paying $500 a month more for her car. For the loan. But anyway, what I'm getting at, the freedom that it's given me, Sonu, to not always just be. We've got 2 boys; we drive them around still. But I'll tell you, I think it's worth it. I think paying that extra money is worth it to sleep in a little bit in the morning sometimes, and not anyway. All right, so Sonu, a couple things from me that I thought were interesting. If you start in 2000, right, overall net worth, U.S. net worth, household net worth, up 250%. Credit card debt up 125%. Now, this might not be apples to apples, I'm aware, but net worth is up a huge amount. So maybe there is a little bit more credit card debt out there. And like you said, disposable income up 1.33 trillion. That's up 6.9% last year, well above the 988 billion that we saw overall household debt increased. Talk to me. Let's finish this up. As a percent of disposable income, I love this stuff. Like, there's a lot of debt, but as a percent of disposable income, how is that looking, Sonu?
Yeah, if you look at just credit card debt overall, because let's assume credit card debt ideally you pay it off every month. Okay, so then you use disposable income for that. Credit card debt overall is running at 5.5% of disposable income. That's where we were at pre-pandemic, right? But again, you go back to what's the biggest when you talk about your so you get paid every month, right? Or biweekly, whatever it is. And the biggest component of servicing debt is probably a mortgage for most households. Like home ownership rate is 66% in the US. So safe to say majority of folks own their home and they're paying, a lot of them have a mortgage, right? More than renters. And that effective mortgage rate is about 3.5%. That's really low, and even as incomes continue to increase, right? So that and obviously because of debt, inflation, all of that, the real value of your debt has actually gone down. So I think, especially homeowners, I'm not saying renters. Renters, we know rents went up, and we're dealing with that with the whole inflation thing. But on the home ownership side, I mean, homeowners have made out pretty well, I think, over the last few years.
Well, no doubt about it. Maybe one final thing that I thought was interesting. This is some amazing work that you share with, we call it Sonu's Daily Note that goes out to our Carson partners. You looked at listen, there are some people that are having trouble paying their bills. We've seen some of the delinquencies and derogatory things that are taking place, starting to move up a little bit on credit cards specifically. But you pointed out, Sonu, if you just simply looked at the overall balance of all the debt that's out there, okay, this is again, according to data from our friends at the New York Fed. On-time payments are running at 96.9%. All right. The fourth quarter of 19, which we thought that's pretty good economy, was running at 95.3. The fourth quarter of 07, yes, believe me, trouble was coming then. The on-time payments were 93.3%. So, yeah, I mean, some people are getting behind, and we're not naive. Some people are struggling, but overall, the consumer is wildly stronger than I think the media and a lot of other people think, right?
No, I think that's that statement basically underlines the whole thing. You look at delinquency status, and it's rising for credit cards and auto loans, but you have to look at the whole picture, right? If you look at overall delinquency status, and the worst ones, 120 days late plus severely derogatory balances, right? As a percent of total balances, it's running at 1.5%. Before the pandemic, we were running at close to 3%, almost double that. So I think that just says it all.
And believe me, this stuff comes out quarterly. We watch it. We'll talk about it every quarter. So if there's trends change, information changes, what do you do, sir? The famous quote there. We'll change our tune, but overall, the consumer we just think is still in pretty good shape. So with all of that, not necessarily signing off. We're going to transfer. If you watch it on the YouTube channel, watch this, because I think Sonu and I will just change our shirts. We'll change maybe our hair. Everything will change here in about a second. But again, this is episode.
I did get a haircut in between too. So
really? Oh, this is gonna be funny. This will be funny. Go to YouTube and watch it. Watch Sonu's hair change right before your eyes. Episode 72, talking about Bitcoin ETFs with Matt Hougan, sponsored by White Charts. Sonu and I are going to sign off, but we'll be right back in a second with Matt. See you guys there. All right. As we just said, Sonu and I are extremely excited to be joined by Matt Hougan. Even though he spells it differently than Hulk Hogan, they are pronounced the same. Matt, we're going to have a lot of fun talking about Bitcoin, the race to the ETF, all your career, lots of stuff in 20 minutes. But just to keep everyone happy, can you give us your exact title, please, sir?
Sure. Matt Hougan. I'm the Chief Investment Officer at Bitwise Asset Management.
Perfect. Again, we're excited. I mean, you're not related to Hulk Hogan, right? I mean, let's just start because people are going to see this on YouTube and wonder. Just to get that out there, you're not related to Hulk Hogan or distant cousin.
The people listening to the podcast should imagine me enormously built, like I work out a few hours a day.
Right.
No, I'm a skinny little, ETF crypto guy, no relation, but the name is pronounced the same.
There we go. Well, Sonu, go ahead and start things off here. Let's have some fun for 20 minutes.
I mean, not so little anymore. I mean, it's been a big month for you, right? I mean, there's been so much going on. I mean, getting approval for the ETFs, all of that. But one thing, let's start with this. So clients could always buy, or like anyone on the street, like all of us, we could always buy Bitcoin. You can go to the exchange, Coinbase, wherever, and buy good Bitcoin once you figure out how not to lose your password once you have one, and and to keep it in place, right? But it's been harder, I think, for the financial advisory industry. Like if you have a financial advisor, or if you are a financial advisor, it's been harder to allocate to Bitcoin, right? So talk to us about how big a deal this is, what just happened with respect to Bitcoin ETFs.
Yeah, it's a massive deal. It's opening up what has been the best performing asset class in the world, one which, as you mentioned, a lot of investors want access to. It's opening it up to the financial advisor community in an easy way for the first time. Bitwise has been managing crypto assets for 7 years. We work primarily with financial advisors. It's been possible to allocate, but it had challenges. You had to use a private fund, or maybe you're using an app on your phone, or you were investing in a hedge fund. It was difficult. The ETF makes it easy. It's probably the most secure way that's been developed to access Bitcoin. You have institutional custodians, you have SEC protections, you have auditors like KPMG, and it's low cost. So it's opening it up to this big market. And when you think about it from an asset class perspective, Bitcoin went from zero to about $1 trillion, mostly on the back of self-directed retail investors. But that's a minority of the market in the US. That's maybe 20% of the wealth. This is opening it up to that other 80%, and it's a really big deal.
No, what's so exciting to us is by the time a lot of people listen to this, we on our platform with our Carson partners, we will have this ETF on there for them to use. So but just thinking out loud, there's 9 of these, right, Matt? There's still 9, right? None of them went away. There's still 9 as of now, right?
That's
so
right.
I mean, that's what I'm getting at. Do we really need 9? I mean, of course you want yours, but will there be 9 existing in 2 years, you think, or where's this going? And then the other question, how have the flows been? I mean, we've seen some of the flows. You've been happy with the flows to the Bitwise ETF, or your ETF on Bitwise, or how's that treating you the first month?
Yeah, actually, I'll just add to that question. Like, is there room for all 9? Just to, underline
better way to put it. Yeah.
Yeah, I love that question. Of course, we only need one. We only
there
need
you go.
Lowest cost on day one, crypto expertise. Look, I think there are going to be multiple winners here. I don't know if we need 9, but I think you've seen at least 4 funds gain substantial traction out of the gate. And that's because different advisors will want different things. Bitwise's fund comes to market with a 7-year track record of managing crypto expertise, the lowest cost on day one, expertise in trading, and then a company you can call to answer questions that your clients might have about crypto. That's a very valuable package, and that will appeal to a lot of people. BlackRock has an ETF, and they have a huge brand name and a lot of trust. It's slightly more expensive, but that's a very attractive package for another group of advisors. So I think there are going to be a handful of winners. Look, you look into the market, there are a handful of large S&P 500 ETFs. There are a handful of large gold ETFs. There'll be a handful of large Bitcoin ETFs. Do we need 9 or 10? I don't think so. But I think we'll have 4 or 5 major funds in the future.
Let me ask one more, and so to jump in. So about on the flows, obviously GBTC's always been there. To explain to me why that's always been there, but now we've got these new ETFs, and of all the flows, and I know the answer because I've been following you on X, so I know you the answer, so I'm giving you a layup here. Have all the flows simply come from GBTC into the new 9, or is there actually more money coming into these ETFs?
Yes, great question. So GBTC.
Hey, I learned it on your Twitter feed. Okay, so that's where all my questions came from.
The best source.
There you go.
Sure.
From the horse's mouth. There you go.
That's
Yeah.
right. That's right. So GBTC was a OTCQX traded trust. As the background, the first application for a Bitcoin ETF was filed in 2013. And so the SEC took 10 plus years to approve the first spot Bitcoin ETF. In the interim,
make it easy.
Yeah, I was 7 years old when we first filed and had no gray hair.
Yeah.
In the interim, the industry came up with these other tools to access, and the biggest one was GBTC, which held $26 billion of Bitcoin. Right, it's a big product. The issue was it could trade at premiums and discounts like a closed-end fund. And so what happened on January 11th when they approved these ETFs is they launched 9 new ETFs, including BITB, the Bitwise product, and they allowed GBTC to convert from an OTCQX traded trust to an ETF. So it became on day one an ETF with $26 billion. But GBTC has a very high fee. So they had a 2% fee. They lowered it to 1.5%. And BITB launched with 20 basis points. So when you have that sort of separation, of course, you're going to see some assets flow out of GBTC into these new funds. And we've seen 6 billion of outflows, but we've seen more than 8 billion of inflows into these new products. So they've had net flows of $2 billion. I think some of the GBTC was inorganic. So I think that represents net new demand. Look, these ETFs are amongst the most successful ETF launches of all time.
Right.
The ITB, our fund, pulled in more than $700 million in its first month. That makes it one of the top 25 launches in ETF history. So there is real demand for these ETFs, and that demand is continuing. Actually, flows are re-accelerating.
No, congratulations on that. One thing, the way you mentioned Bitcoin was interesting because you mentioned it as an asset class, and for ages, I mean, it's been talked about, I think, on the street, literally, and I don't mean Wall Street, I mean, like Main Street, as a currency, right? So maybe you can get it, like how you view Bitcoin as an asset class versus a currency, and also like, and this may be a corollary to that, like my wife, for example, or someone, a lot of our clients too, like we manage, our advisors, we have more than 300 advisors here at Carson. We manage, wealth for 48,000 households or something, Ryan, right?
49,230 something. Yeah, we're on our way to 50. On our way to 50.
Close to 50,000. Mm-hmm. So a lot of them have what we call like moderate portfolios, like 60% in stocks, 40% in bonds, right? That's kind of been a standard approach, for a lot of people. How we do it exactly may be a little different, especially the way, like, for example, Ryan and me and our team manage these type of portfolios. But essentially, that's what it is, right? Where does Bitcoin fit in that portfolio? Why should it fit in there?
Yeah, absolutely. Look, if you strip the name away from it and you just looked at the data, you would see an asset with high historical returns, an asset with high volatility, it goes up and down and up, an asset with liquidity, and an asset whose correlation to stocks and bonds tends to be very low, typically between 0.25 and negative 0.25. So what do you do with an asset that has high potential, high volatility, and low correlations? You treat it kind of like hot sauce. If you sat down and had a dinner that was just hot sauce, you would be very unhappy. And that's the same as if you had 100% of your portfolio in Bitcoin. But if you add a little bit of hot sauce, 1 to 5% into a portfolio, it can enhance your risk-adjusted returns. And actually, the data on this is enormously convincing. I'll tell you some fun facts. There's never been a 3-year period in Bitcoin's history where adding it to a portfolio didn't substantially increase not just your absolute, but your risk-adjusted returns as well. In fact, there's never been a 2-year period where it didn't increase your absolute returns. And the reason is you can rebalance it, so you can harvest some of that volatility. So I think it gets put in this difficult to access bucket because it's this exotic new thing. Yeah. But if we just think of it as an asset and what are its characteristics, advisors know what to do. You have to add it for clients who it's appropriate for and only the right amount. And you have to rebalance it like other assets. And historically, that's made it a great contributor to portfolios.
Well said there. I mean, so Matt, one thing that gets me, as we follow the industry in general, there are a lot of places that now these ETFs are out there and they're still saying, you know what, we need more time to look at this. we need more time to think about this. We don't want, our advisors to necessarily invest in this yet, so we're going to hold back. What do you have to say to places that make that decision? Because to me, it's like, it's time, but obviously I know you're in that camp too. Why are people still waiting? What are we waiting for?
Yeah, I mean, first I'd say to places that are making the opposite decision that you're giving your advisors an advantage, because we know investors want it, right? There are 56 million Coinbase accounts. That's more than there are Charles Schwab and TD Ameritrade accounts, right?
Wow.
Retail investors want access. And guess what? They're going to do a better job investing in this asset class if they have an advisor holding their hands, right? If they have an advisor guiding them not to buy it after it runs up or sell it when it pulled back, but to use it in a portfolio context. So I would say to that group, you're giving your advisors a real advantage. The other people will come along. I honestly think it's almost anchoring bias, right? They haven't taken the time to study crypto. They haven't thought about the fact that this is not the crypto of 2013 when it was an experimental idea with savory and unsavory characters. This is a crypto where you have firms like BlackRock and Fidelity, where Bank of New York is the administrator for our fund, where KPMG is auditing it, where it's been approved by the SEC. This is, you have to strip away what you thought you knew and evaluate it as is. They're all going to get there. I feel confident they're all going to get there. It's just some people are more willing to look at the facts as opposed to let the history color their.
Well, you are on the Facts versus Feelings podcast. Yes. So there you go. One more for me, and then Sonu jump in. Yeah. So I think it's interesting. We got these Bitcoin ETFs. You know where this is going. What I've noticed the years I've been following, it's like the Yankees and the Red Sox, right? Your Bitcoin or your Ether. I'm over here. When are there going to be other ETFs from some of the other big cryptos that are out there?
Yeah, great question. I think it's reasonably likely to assume we're going to get a spot Ethereum ETF, and maybe ETFs that combine Bitcoin and Ethereum.
Okay.
It's a pretty big leap from there to the next largest asset, which is Solana, because there are no regulated futures contracts. They aren't in the regulated community. But I have there's a good message about Bitcoin and Ethereum, which is those are the two biggest use cases in crypto. It's digital money and a programmable blockchain. Right? Together, they represent about 75% of the investable market cap in crypto. So if we get those two things, you can have pretty good exposure to the space. Now, some people may want to experiment further down the chain. Bitwise offers an index fund, for those sorts of people. But it's difficult to access. It's not an ETF. It's for accredited investors. It has challenges, right? So I think we're going to get Bitcoin and probably Ethereum. And then a few years from now, we'll get these other assets. But we're moving in that direction.
You mentioned digital money, and that gets to a big piece of this, right? Like, because say if I have $20 in my, wallet, I hand it to Ryan. He's got it now. I don't have it. Right?
You're not getting it back, by the way. I mean, Matt, he still owes me a steak, man. I bought him a steak last time, so I know he still owes me a steak. So mark that down.
I owe more than $20. But that gets it. That's actually an important point. He's not going to give it back to me unless he wants to. He's got that $20 in cash, right? Whereas you make a credit card transaction or Venmo or whatever, there is a certain period of time where it's cancelable. Right? Yeah. Whereas a cash transaction, you cannot cancel it. And that gets to digital money. It's literally like cash, right? Yep. You transfer it. Unless the other person wants to give it back, you're not getting it back, right? There's no intermediate person or bank that can come in and cancel that transaction, right? So I feel like there's a certain irony where crypto started as sort of wanting to do away with intermediaries. And now with, Bitcoin ETFs, especially since it's an asset class and you want that cloak of regulatory approval, now you got so many middlemen and intermediaries. I'm not saying that's a bad thing. I think it's a good thing, to several points you made. But I feel like there's a certain irony. There's a rich irony there as to how it started and where it is now. I don't know if you see it that way too.
There definitely is an irony there of taking this asset, which is all about, self-sovereign custody of wealth, and then packaging it in an ETF to gain access to it. But if you sort of abstract from the philosophical perspective, the existence of an ETF doesn't change the fundamental nature of Bitcoin. If you want to, you can still memorize 12 words in your mind and carry $100 million anywhere you go, right? In the same way that a gold ETF didn't do away with the fundamental characteristics of gold. In fact, what it did was it brought gold into the mainstream. a Bitcoin ETF did the same thing. And I'll give you a fun fact from ETF history, because of course, before I joined Bitwise, I was the CEO of ETF.com. When the ETF launched, people worried that the ETF was going to displace the physical holding of gold. People weren't going to buy gold bars and gold coins. But actually what happened is that the volume of gold bar purchases rose fivefold in the 5 years after the ETF launched. And the reason was, while there is some competition, it grew the market so much, it legitimized the market that overwhelmed it. And I think that'll happen in Bitcoin as well. Look, there is irony of packaging Bitcoin into an ETF, and some people will do that instead of holding it directly. But more than that, it's going to grow the Bitcoin market substantially. So all forms of Bitcoin will thrive. And eventually these two markets are going to come together. We're going to have DeFi disrupting traditional finance, and traditional finance disrupting DeFi a little bit. We're already seeing that, right? And I think everybody
and
wins.
DeFi being decentralized finance, right?
That's decentralized finance, of which Bitcoin is part of that, or the vanguard of that movement. Yeah.
Just coming to the gold piece of it, I mean, speaking of someone with an Indian background, just go to an Indian wedding and you'll see that demand for hard gold is not gone away.
Exactly. That is right. Even though there's $100 billion in gold ETFs, people still want to hold it directly. I love it.
Matt, this has been great. We've got a couple more minutes. So I did want to talk about ETF.com. Were you the founder of that or the CEO?
I was the
connection?
CEO. Yeah, it was founded by Jim Wyatt, but I became the CEO. Yeah.
Fantastic website, by the way.
Yes. Thank you. And you obviously made the switch from ETF.com to, Bitwise. Why did you make that decision, and when was that exactly?
Yeah, so we sold ETF.com 2016, and then after a 2-year earnout, to my wife's chagrin, I took Saturday off and then started at Bitwise on Sunday. So that was my journey. But there's actually a great connection here. Here's a funny thing people don't remember about ETFs. In the early days of ETFs, people hated them.
Yeah.
The Financial Times called them weapons of mass destruction. There were congressional hearings about whether ETFs were destroying American entrepreneurialism. People called them EFTs. They hated them. But what I saw in my career in ETFs was being early to a financial technology that made the world more efficient and that people eventually realized was very important, was great for my career, right? Because I got to do all these things. I got to build this website. I got to build the first analytics system. So after I went through that phase and sold that business, I looked around, what's the next financial technology that could substantially disrupt existing finance, make it more efficient, make it better, but which people didn't understand and which there was a lot of skepticism towards? And that was crypto to its T. And you're seeing it play out. You saw congressional hearings, you see a lot of caustic commentary, but now you see BlackRock, and now you see Fidelity, and now you see wide adoption. So that is the thread there. That's why I made that leap. I love financial efficiency, and crypto is a big part of that. And I'm excited to sort of have another shot at that goal in this part of my career.
Yeah, that's fantastic. No, congratulations. You've done so well. I mean, it's amazing how much you've accomplished with this stuff.
Well, thank you. Yeah, just getting started. We're really excited.
Yeah, but one more from you, Sonu, the one more from me, and we'll let Matt go.
Maybe we'll go back to the portfolio thing, because ultimately that's where rubber hits the road, right? Like if you're thinking about allocating to this as an advisor for your clients, or if you're a client directly, right? When you somebody thinks of stocks, okay, why would stocks go up? You think, okay, this a forward-looking perspective. I mean, historically, yes, you allocate to stocks. Stocks have gone up in the past. Maybe it goes up in the future, right? But there's a looking ahead. You think, okay, if there's GDP growth, productivity growth, profits go up. That's why we want to be allocated to the greatest wealth generating machine history has seen, which is the stock market. And I would maybe argue, it could be the US stock market, especially more recently, right? And then bonds, you diversify. When stocks zig, bonds zag. Historically speaking, I mean, it didn't do that in 2022, but still, right? You expect that. Maybe you can close off with where crypto fits in that picture from a forward-looking perspective, as opposed to, yes, it's historically done well, like stocks have, but looking ahead.
Yeah. So from a short-term perspective, Bitcoin's price is set by supply and demand. You can think of ETFs as unlocking new demand. And actually, the amount of new Bitcoin being produced each year falls in half every 4 years. The next one of those halvings in April. So from a short-term perspective, the answer is you have new demand and you have reduced new supply. That's a pretty good setup. But from a big picture perspective, the way I think of Bitcoin is that it has two fundamental drivers. One, I think it's a digital store of value, or it's emerging as a digital store of value, a competitor to gold. There's a digital version of almost everything analog in the world. As more people accept that, the market opportunity is significant. Gold's a $15 trillion asset. Bitcoin's $1 trillion. It doesn't have to take much of that market to have real appreciation. And then long term, I think it has a potential to evolve into an apolitical settlement rail. Right now, global commerce moves primarily over dollar rails, but we're moving into a multipolar world. I could imagine countries wanting to settle in an apolitical rail 5-10 years in the future. And the only viable one for that is Bitcoin. Will we get there? I don't know. I think of it as an out of the money call option. We don't have to. All we have to do to make the Bitcoin investment successful is for more people to want to store money in a digital format that can move at the speed of light. I think that's a pretty good bet. So that's where I think this is going. That's where I think the return driver is as it sort of enters those target markets. And again, those are multi-trillion-dollar markets if it's successful.
Nice. Thank you for that. Lots to think about. That's a great answer.
I appreciate it.
Gold to Bitcoin 15-1. I didn't quite know. I knew it was something like that. That's really interesting. So I guess, Matt, this will be the last question. I always like to say, any mentors and things you've learned, but I'll kind of combine it with, or any mentors by the time people listen to this. I believe you're going down to the exchange conference down in Miami. Any of your mentors going to be found there? So kind of combine those two there.
Oh man, yeah, I'm really excited for Exchange, largest ETF conference. Right now I'm following Eric Balchunas and James Seifert from Bloomberg, the two sort of lead ETF analysts there. They have a great vision for what's going on into the future. The other thing I'm excited about at Exchange is meeting the other people who are building in this space, right? There's going to be a large contingent of people focused on Bitcoin at the ETF conference. And while I'm competing with them, it's also wonderful to see, I'm not the lone professional there. There will be other people doing serious things in the space. And I'm really excited for that experience as well.
Well, Matt, from everyone at Carson and Sonu and myself, the Facts versus Feelings podcast, we really appreciate you taking some time with us today on the Facts versus Feelings episode 72. We're wrapping up episode 72 here. I'll just leave it at that. So with that, everybody, we're going to sign off this week. We'll see everybody at the very next Facts versus Feelings next week, episode 73. Take care, everyone. Bye-bye. Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.